to constitute to real estate.
Welcome back to Conan's Keys to Real Estate, unlocking Utah's real estate secrets, one key at a time. I'm your host, Ryan Conan, a full-time realtor at Real Broker, helping buyers and sellers in Twila and the Salt Lake Valley. One of the biggest myths in real estate is the idea that you need 20% down to buy a home. And honestly, this belief stops a lot of people from even exploring home ownership in the first place. People hear that number and immediately assume they are years away from buying. They start doing the math on current home prices, see how large 20% really is, and decide ownership is impossible right now. But the truth is, many buyers purchase homes with far less than 20% down. Now, that does not mean 20% is bad. In some situations, it absolutely makes sense. But the bigger issue is that many first-time buyers believe it is required when it often is not. So in this episode, I want to slow this topic down and really explain where the 20% idea came from, what actually matters more than the percentage itself, and how buyers should think about down payments in a much more realistic and practical way. Because the goal is not just getting into a house, the goal is buying responsibly and understanding your options clearly. Where did the 20% myth come from? The 20% number did not appear out of nowhere. There actually is a reason it became so widely talked about. Traditionally, putting 20% down allowed buyers to avoid something called private mortgage insurance, often referred to as PMI on conventional loans. PMI is insurance that protects the lender, not the buyer, in case the loan defaults. When buyers put less than 20% down on many conventional loans, PMI is typically added to the monthly payment. Because of that, 20% became viewed as the ideal benchmark. Over time, people started confusing ideal with required, and eventually the myth became widespread. But in today's market, there are many loan programs that allow buyers to purchase with far less down. Some conventional loans allow as little as 3% down for qualified buyers. FHA loans often allow lower down payment options. VA loans for eligible veterans and service members can allow zero down payment. USDA loans in eligible rural areas can also provide zero down options. And beyond those, many states and local housing programs offer assistance or grants that can help qualified buyers with upfront costs. For example, in Utah, programs connected to organizations like the Utah Housing Corporation can provide down payment assistance options for qualifying buyers. These programs change over time, so buyers should always speak with a knowledgeable loan officer about what may currently be available to them. So the reality is this: the path to home ownership is often much more flexible than people assume. Why buyers get discouraged early? A lot of first-time buyers talk themselves out of buying before they ever have a real conversation with a lender or agent. They see home prices online, multiply by 20%, and immediately feel defeated. But what they are often calculating is the maximum traditional benchmark, not necessarily the minimum realistic entry point. And honestly, this creates unnecessary discouragement. Now, that does not mean buyers should rush in unprepared. Saving money still matters. Financial stability still matters. Emergency reserves still matter. But many people are closer to ownership than they realize because they are using the wrong assumptions. This is why one of the most important first steps is simply having a conversation with a loan officer. Not because you need to commit immediately, not because you are ready tomorrow, but because clarity removes fear. A good lender can help buyers understand what loan programs may fit them, what realistic down payment ranges look like, estimated monthly payments, closing costs, credit improvement opportunities, what steps could strengthen their position over time. And once buyers actually understand the numbers instead of guessing at them, the process often feels much more achievable. The real question is not how little can I put down. This is where I think the conversation gets more important. A lot of online discussions focus heavily on the minimum down payment possible, but the better question is not, what is the absolute minimum? The better question is, what puts me in the healthiest financial position overall? Because there are trade-offs with every down payment decision. Putting less down may allow you to buy sooner, preserve savings, or maintain financial flexibility. Putting more down may reduce your monthly payment, lower interest costs over time, and potentially eliminate mortgage insurance. Neither option is automatically right or wrong. It depends on the buyer's overall financial picture, comfort level, and goals. This is why blanket advice online can be dangerous. What works well for one buyer may not work well for another. The danger of draining your savings. This is one of the biggest mistakes first-time buyers sometimes make. They become so focused on reaching a certain down payment number that they completely drain their savings just to hit it. And then after closing, they have almost no financial cushion left. That creates stress immediately. Now, every repair feels overwhelming. Every unexpected expense feels urgent. Every appliance issue feels like a financial emergency. This is why I often think overall financial stability matters more than hitting a perfect percentage target. Having reserves after closing is incredibly important. Homeownership comes with maintenance, repairs, moving expenses, utility adjustments, and ongoing costs that renters may not have experienced before. So while putting more down can absolutely help in some situations, buyers should not ignore the importance of liquidity and flexibility. Sometimes keeping additional reserves available creates a healthier long-term ownership experience than putting every dollar into the down payment itself. Monthly payment matters more than the down payment headline. Another thing buyers often misunderstand is how the down payment impacts the actual monthly payment. Yes, a larger down payment usually lowers the payment, but many buyers are surprised by how much or how little the difference actually changes their monthly numbers, depending on the situation. This is why looking at real payment scenarios with a lender matters so much. A lender can help compare different down payment amounts, different loan structures, PMI scenarios, interest rate impacts, estimated taxes and insurance, and sometimes buyers discover that a slightly smaller down payment still creates a payment they are very comfortable with while allowing them to preserve savings. Other buyers realize they would rather wait longer and put more down to reduce long-term costs. Again, neither approach is universally correct. The key is understanding the trade-offs clearly instead of relying on myths or assumptions. Let's talk about PMI honestly. A lot of buyers hear mortgage insurance and immediately assume it is terrible. Now, obviously, nobody loves paying additional costs, but PMI is often misunderstood. For many buyers, PMI is simply the cost of getting into a home sooner without waiting years to save 20%. And depending on the loan structure, PMI may eventually be removed once enough equity is built. So while it is definitely a factor to evaluate, it should be viewed in context, not just emotionally. Because waiting several extra years to save 20% while home prices or rents continue rising may not always create the better long-term outcome either. This is why these decisions need to be personalized. The emotional side of down payments. I think there is also an emotional side to this conversation people do not talk about enough. Many buyers feel embarrassed if they cannot put 20% down because they think it means they are financially behind. That is simply not true. Real estate markets, wages, rents, and home prices have changed dramatically over time. The path into home ownership looks different now than it did decades ago. The important thing is not whether your down payment matches someone else's story. The important thing is whether you are buying responsibly within your own financial reality. A buyer putting 5% down with stable income, reserves, and a manageable payment may be in a far healthier position than someone forcing 20% down while draining every account they have. Financial health is bigger than one percentage number. Why education matters so much here. This entire topic is a great example of why education matters in real estate. So many buyers carry fears that are based on incomplete or outdated information, and when people do not ask questions early, they often spend years assuming ownership is impossible when they may have had options available much sooner. This is why conversations with good professionals matter. Not sales pressure, not rushing, not forcing decisions. Just clear information and realistic planning, because when buyers understand their options clearly, they make far better long-term decisions. My final thoughts. No, most buyers do not need 20% down to buy a home. While putting more down can absolutely have benefits, it is not the universal requirement many people believe it is. The better question is not what is the minimum possible, but what creates the healthiest financial situation for me long term. A strong down payment strategy balances affordability, monthly payment comfort, and financial stability after closing. The key is understanding your options, talking with a knowledgeable loan officer early, and making decisions based on your real financial picture instead of outdated assumptions or internet myths. This is Conan's Keys to Real Estate Unlocking Utah's Real Estate Secrets, one key at a time.